Hey folks, Nick looking at Twitter. Today is 11/5. It's Friday, and I'm running on fumes, so I figured I'd spend more energy doing another video. The opportunities are everywhere. This is what happens during the earnings season. Everything moves this way or that way, and we either feel the FOMO to chase up, like with the breakouts. I can't remember any of them right now, or um, Datadog, for example, or wishes like Moderna, like Twitter, down to where we feel like, oh my God, I need to catch this falling knife, like Peloton. Well, there's some things I should just use just simple logic. Um, Peloton, I just got a question. What about Peloton? Okay, so technically it hit a level that I thought was doable. In fact, that's how I drew it. I didn't forecast it was going to happen, but I said if this happens, then this is the like this here is a possibility, and that was months ago or weeks ago at least. But I didn't tell you it was going there. But I said if you lose this, then you're going here, and that's what happened. So why bother? This technically is a viable dip from a chart itself, but it has so much junk going against it, like the fundamentals going against it, the spirit of unlocking the world, blah blah blah, and on top of it, the lawsuits from unfortunate events with somebody dying, etc. Why there are better knives to catch? Like Moderna did nothing wrong. In fact, it grew 3,000% and 1,400%, and this is what happened to the stock. So, and this too is falling into support levels. And just because we have one extra pill, anyway, this would be a knife I would catch before the other one. In fact, I would avoid both because they're both wacky. So that brings me to Twitter. Somebody asked me, what about Twitter? I was like, you know what? I don't like the platform because of the political angle. Not to be a judge one side or the other. Companies have no business being political because they are public. If it was tightly held company, then the owner of the company is free to do whatever they want. But when they have money from us, everybody, owners, if you buy shares into a company, you're part owner, so your opinion should matter. Why do they force you into a political side or another, or act or bring pain to the stock from potentially from political stuff? So anyway, not my favorite company, but it would be a better knife to catch than the other ones. Um, so it too is falling into, well, fell on earnings and has a few days. I'm counting about a week worth of consolidation at a prior bounce level, which was a prior fail level and a breakout level. So that makes sense that this zone has buyers. So if somebody wants to start longs in Twitter, however somebody does their longs, it's not crazy. There's no imminent proof it's going to rally. In fact, it has room to fall. It just made a lower low than the last week. So that's not a good sign. But if the markets hold up, this should stabilize. Same with Snapchat. So yesterday I had an epiphany. Look at this. Snapchat, same, exactly the words I said for Twitter here, except Snapchat is holding higher on a day basis. So this is a daily chart. If I zoom in, so these are 3 days, higher lows somewhat, at least not a lower low. Let me go back to Twitter. It just made a lower low. So better, not as good a posture, but they're both catchable. How would I catch either of those two? I would buy shares for the long term. Not all in. We don't know what the markets are going to do. They are at all-time high, folks. The bulls are in charge, but I cannot load up all in. I can buy calls way out in time, January, closer to the money the better. I can buy call spreads. Those are less aggressive. I can sell a put to own shares below current price, leave room for error. I can sell a put spread and take the risk, a calculated risk. That's a bullish position that does not need a rally to win, which are usually my favorite ones. Limited upside, but hey, I have room for it to fall a little bit and I can add calls later. Okay, so which one of those two I prefer? So last night, I kid you not, epiphany. I just had an epiphany. So Google Glasses. What is Nick talking about? So follow me for a second here. Google Glasses was a great idea, in my opinion. I couldn't wait for the second and third generation for me to be able to put glasses on and have a screen and interact with whatever on the go, not have to whip out my phone and look at it, just a projection on my screen somehow. Even if it clips onto my glasses, I don't give a crap. You know, like the old science fiction movies? Great idea. Because distance to eye will give you the impression that you're watching a 60-inch monitor. That's what works out with the phone at about, I don't know, 2.5 feet, a foot and a half away from my face. I did the math one time. So anyway, you know what the tagline is for this company? They are a glasses company, spectacle company or something, or camera company, and glasses. So what if they have something in the long term along those lines? So I liked this one over Twitter for the long term. If I were to buy a stock and stash it, this would be it. They seem fiery, feisty, fighting the good technical fight against giants. And you know, Facebook is a huge giant that fights against them with Instagram, and these guys are always one step ahead. So what if they are the people to bring in the next new thing that people are going to be wearing all over the place? Anyway, between the two, I'd catch the falling knife of this one. Again, how do I do it? Buying shares works. Let's see here. If I wanted to buy calls, let's a quick lesson on options if you don't know what they are. So this is an options chain, and I can use, these are contracts between buyer and a seller. They're not bullish, they're not bearish. Depends on what you do with them. So if I go to January, this has got 77 days on the clock. It's a contract. This side they're called puts, this side they're called calls. If I buy a call, I don't need shares. I just am reserving my right to buy the shares at 55. And instead of buying 100 shares and spending $5,500 out of my pocket, I spend $400 and I lock my price for 100 shares. How do I do that? I just buy a call. So that would be a getting long the stock indirectly. I don't own shares. If it pays a dividend, I don't participate until I exercise my right. So what does this give me? It gives me the right, not the obligation. I don't have to do anything with it. I pay for $100 today because it represents 100 shares times $4. And I'm locked. What if price rallies to 1 million tomorrow? I can have my shares at 55. Who's on the hook? The person that sells it has to deliver the shares. Nobody should sell naked calls. Okay, buying naked calls, that's fine. What is a naked call? This is a naked call. One call, one leg, 2 of it, 3 of it. That's on you. So if I buy 2, it's 200 shares. 300 shares. So I spend $400 on long snapshot for 77 days. Time is of the essence. If time passes, nothing happens. This $400 disappears. Poof. If price drops, this $400 gets cheaper. I'm losing money. I don't lose my spot. I'm still reserved at 55. I can exercise that at any point in time. Price does not have to be above it, but I'd be an idiot for doing it if it's not. Anyway, so that's one way of getting long. I said call spread. A little less aggressive is this way. Why? Because I'm literally spreading the risk. I buy a call, I sell a call, I spend less money now. I'm spending $250. What's the downside of doing that? I limit my upside potential. Now I can only turn $250 into $1,000 only per contract. So because I'm long here, I'm obligated short here. But you said, Nick, don't sell a call. I said naked call. This is not naked. I'm long at 55. I'm short at 65. So if it goes to 1 million, I can only make $1,000 in total minus the $250 I invested. Only. What's wrong with quadrupling my money? Nothing. This one loses less fast and wins slowly and wins slowly. Okay. The alternative is to sell a put and commit to owning shares. Selling a put, I'm not going to discuss right here. So which one would I do? I would choose Snapchat for the reasons cited. However, both of them, if the market hiccups, they're both going much lower. This one will be at 40, 41. There's a gap down to 32, 31, 30, heck. So why am I saying all of this? Because let's zoom out a little bit. Look at this. Now it looks like, oh my God, 30 is not that low. That's, where is it? Right there. So June of the pandemic year dipped and then took it out. Look at this move. Wow. Okay, so that's a good base right there. All right, so hopefully you can't hear my son's new freaking monster in the driveway. Okay, race car. So let's see here. Twitter, slightly more a slightly clearer zone of support. So Twitter might have a drop to here, not as far as Snap. But I like the other one company, as better. Similar boat. This one is a little more altitude, but they're both too high. But if the stock market holds up, they're both going to be fine.